Investors have filed a series of court cases alleging that primary dealers responsible for underwriting the US government's debt manipulated the US Treasury market. The cases differ slightly in their detail, but are expected to be consolidated into one, marking the latest call of rigging that has infected currency markets and some interest rate benchmarks already. The claim is that primary dealers increased the price investors paid, while simultaneously colluding to cheapen the price they paid at auctions. Auctions are facilitated by the primary dealers, who submit private bids for themselves and investors. Investors can also go direct to the auction, circumventing the dealers, a trend which has been growing in recent years. The winning bid is the lowest single price at which all the securities can be sold. The cases began being filed shortly after the Department of Justice and the New York Department of Financial Services began their own investigations and rely heavily on analysis of price data, comparing existing US Treasury securities with prices given for Treasuries at auction. Some Treasury traders that spoke to the FT on the condition of anonymity dispute the analysis, saying there are many reasons why the price at auction is different, including the sheer size of some auctions that need to be digested, as well as the risk that the market might move between the time a dealer puts in their bid and the time the auction closes, which is usually around 1 minute. Cases are right at the start and likely to run for some time, with close watch being paid to regulators' own investigations to give some indication as to the potential outcome.